And in today's video, we are going to take a look at gold versus S&P 500 as an investment and comparing 49 years of returns for gold versus the S&P 500. So we're going to take a long because I've heard people say gold is a long-term investment, and I'm going to show you that's actually not true. Gold has a 10-year window where you could make a profit off of it. And let's take a look at. Okay, so why did I pick 49 years? Well, I picked 49 years because I wanted to give gold the best chance of winning against the S&P 500. And if you look at gold from okay, December of 1970, that is the lowest price in our lifetime for gold. It was in December of 1970 at $235.70. There it is. December. So if you had a time machine, go back to December of 1970 and buy gold at $235.70. And let's take a look at where your gold would be now. Where that gold would be now. So do you buy it at December 1970 and price today in August 2019? You calculate that, and it is 3,350%. So if you had $1,000 invested in gold back in December of 1970, it would be worth $33,508.70. So let's take a look at S&P for that same time. And December 1970, August 2019, our $1,000 invested, no monthly contributions. And when we calculate it, here's what we got. $78,794.60. And the great thing is capital gains tax means it's not that high. You get to keep $69,460.31. You know? Anyways, yeah, capital gains tax is much lower than regular income tax. So you get to keep a lot more of it. And that's the other benefit against gold. Gold it does receive some tax breaks over ordinary income. Like the highest tax bracket is 35%, and apparently the top tax bracket for gold sale is 28%. So you get taxed a little bit less, but it's almost the same. It's almost the same. It's certainly not as low as capital gains taxes of, capital gains taxes. So I want to concentrate on this year because the stock market for 10 years did really horribly from August 2000 to 2011. It basically went nowhere. Okay, what basically went nowhere for 10 years. And if we look at gold prices, look at this. Gold prices during this exact same time did its best. And it did its best because it went under $400. And when gold went under $400, investors left the stock market to go into gold. And if you did that, you would have a 10-year bull run on gold up to over $2,000. And so from 2001 to 2011, that's 10 years, gold went on a bull run, and you made a lot of money, and you made more money than you would have if you were invested in the stock market, which basically went zero for 10 years. It went $0 over 10 years. But gold went up like 500%. So if gold goes under $400, I would be worried about the stock market. You know, you should think about selling your stocks and moving to gold. But gold is nowhere near going under $400. And look at this. Gold has a potential of going all the way down to $235, but it only dropped to 300. It only dropped under $400. Who knows where the bottom of gold is? And that's the other thing is this curve is not an investment that you want to be in because look how sharp these declines are, and these declines take 20 years. Look, this decline from 1980 to 2001 took 20 years to reach the bottom of gold prices. And if you look before that, it took 36 years from the high in 1934 to the bottom in 1970. That's 36 years of decline in gold prices. So the last time we hit the high of gold was in 2011. We have so much farther to go in gold price declines. We're not even at the halfway mark right now. If history repeats itself, this is going to take 20 years to reach the bottom of gold. So in 2031, if you see gold heading near all-time lows, that would be the time to get out of the stock market and buy gold. But we are nowhere near the bottom, so we are not in a situation from 2000 to 2011. You know, these 10 years where gold was just crushing the stock market. You know, we're nowhere near those prices for gold. So I would not be worried about the stock market with gold at this high of a price. Okay, I hope you enjoyed this video, and I will see you in the next one. Take care.